Welcome back to Primary Source China Investment. Peng.guo and I are here in the snow on a chilly day, but we wanted to get into some of the stock and China equity performance indicators so far this year. As we remember last year, there was a big downturn in a lot of the tech stocks, and the large indexes for the A shares were relatively flat. So, just 1 month into the year, where are we? Well, there is a big headline coming out on both sides, which says, A, China stocks are in a bear market, and B, there's a lot of foreign money flowing into China. So both of these things can be correct. So let's look at it a little bit further and break it down into what means China exposure. And the large indexes on the mainland, Shanghai Composite and CSI 300, are down 7.6% respectively, a few bips to the left or right of that. And if you thought that the small, high-growth star Chinex would provide a boost, well, that's down 13.5%. In Hong Kong, the Hang Seng is about flat, down 1.28%. On the U.S. side, A share, ASHR, is predictably down 8.2%, because remember, that follows the mainland listed A shares. And my favorite bad idea, KWEB, is down about 6.5%. Recall last year, ASHR was down about 2.5% for the year, and KWEB was down 50% for the year. So how far down is down? Well, the PE ratio, again, nobody looks at PEs until everything sells off, right? So the PE ratio of ASHR is about 15, and KWEB is still about 100. Interesting, I saw an SEC filing for a 2 times short KWEB. So look out for SWEB for those so inclined. So Peng.guo, where do you see the market right now as the first month into 2022 and the beginning of Chinese New Year? I should have mentioned at the outset.
I think firstly, this is a year of the tiger. Wish everybody a powerful, vigorous, mighty, and the lucky year of the tiger.
Absolutely.
So I think from the traditional, this is a great year for Chinese people. From the market, so obviously it's in the bearish right now. There's a lot of the discussion and the research probably on the way after the Chinese New Year.
Nobody's working now.
Work on that. I think generally speaking is firstly why we see the China market really we see by sector. Different sector performance is significantly different. So that's why overall Shanghai Composite Index, they pretty relative drop not too much. For this time is really like the previous sectors. They just grow too much. The price is too high. They are leading the drop a little bit like the Nasdaq. Mm-hmm. So their performance is better than the SP 500 and this round. So they are leading the drop and drop much more than SP 500. So a couple of the sectors, bank sector. So this is not grow, but recently it rebounded and stable the index. And also the solar as well as the new energy sectors, they all performance well. They get dropped, but not dropped too much. So other sectors is pretty bad. Looks like significantly and perform than the major index. I think this is in China. We know the private fund market, but the private fund market have the big difference compared with the Western hedge fund or mutual fund market. They have the stop loss line. So stop loss really means 20%. Most of the time, like the 25% to stop loss. So they have to cut their loss and the selling, which in turn push the market down, especially for quant-driven and fund. So I think that easily to crash the market in a short time. Is everybody sell at the same time.
Oh, so you think the catalyst this time is a lot of those high frequency traders who have hit a limit down and then they're forced to sell?
That's right. That's the major reason, not one of the reason. Another couple of the reason is a lot of the companies they have the release the annual report. So some is not good, and obviously plus the Chinese New Year. So everybody want to get the cash and avoid the 1 week to doing like that. So all those things combined together might be good advantages, give the short investors opportunities. So they get, I think they reach a pretty good return recently. And also, I believe the private fund market stop loss is a major reason contributor to short drop.
I see. And I want to circle back to something you said because our subscribers are different, right? You know, we've been in front of this policy discussion for a long time, and there's a couple of things that you mentioned that I want to circle back to. So the first is on the policy side, there's dual circulation, shared prosperity, ESG, like you mentioned. And we've been telling our listeners to focus on those large state-owned enterprises. And there is an index. It happens to be Hong Kong based, but it does follow a lot of those large size, a lot of the financials, large size, China-based SOEs. And these are a lot of dual listed. I don't want to get too complicated, but these are stocks that trade in Hong Kong and are state-owned mainland index. And year to date, that's up 6.5%. That's significant outperformance given the names in this index. Those are the large names that trade on the mainland, the sleepy SOEs as they're so called. So there's definitely some flight to that. But as we know,
that's true.
Yeah, as we know, so goes Baijiu, so goes the major indices. You remember, what's the largest holding of CSI 300? That's Maotai. That's Maotai. So you can see the chart on that. So I think what you're saying is this rotation into some of the safety because there's large names, but also this rotation because the policy is dictating this rotation as well.
That's exactly right. Especially in the pandemic selling period, a lot of the institutions, they probably more focus on the high quality, state-owned or large cap, and sell the small cap and high risk, like the low valuation companies. So speculation is pretty get hurt in the downtrend. Yeah, that's why we should avoid the downtrend. And you cannot expect that don't do the rebound or something. Just wait to market to the bottom and then gradually to enter into the market. As to the KWEB, in my personal opinion, that is still suffer the conflict between the China and the United States policy.
Definitely.
So yeah, that's some of the companies may be delisted, some companies can keep it. Then that's no right answer about that. They're arguing with that. Unless the both government, if they achieve some kind of agreement, you can say they will rebound like the 10% overnight pretty quick.
Yeah, but if you look at the risk profile of that, there's way too much uncertainty. So people who want to try to get in and scalp 10%, oh, I'm going to buy it because it's been off so much. I just mentioned at the outset, this still has a PE of 100.
That's true. That's probably the another major reason. So valuation definitely is a very important factors. So without a good valuation and the growth performance or story support the stock, my suggestion is, you cannot do the long-term.
Yeah, well, you can go buy SWEB, which is the 2 times short KWEB. It's a crazy product.
Yeah, that's just for the speculator or for the shorter professionals to do that. It's pretty hard and easy to get hurt, and also obviously need a lot of research.
Yeah, your downside risk is much higher than your upside possibility. Yeah. So there was one other thing I wanted to bring up because we're mentioning these large SOEs and this flight to safety. Everybody knows I love CBON, and I'm going to circle back to CBON because it's up 80 basis points year to date, and it's important to remember what this fund holds. So they're going to be holding a lot of obviously Chinese government bonds, but also a lot of Chinese state-owned enterprises. And are there any property developers in here? These kind of headline risks that we're looking at. So in the top 10 holdings, I'll put those up there. Absolutely no. There's no There's no property developers. And I did take a look at the 100 holdings, and I can only find one property developer, which is Wang Ke. And this is actually largely owned by the subway development company in Shenzhen. So it is also a state-owned enterprise as well. So I looked through the 100 names and only found one property developer in there. So again, I keep circling back to CBON. Unfortunately, nobody's really listening, but this is a great product for U.S. investors to get some yield and have pretty low volatility and low risk.
I totally agree. Looks like this bond, the ETF performance pretty well and much better than the equity. Generally, the bond that's pretty safe. So as soon as they qualify to issue the bond to the foreign investors, they must get a lot of the screen criteria or meet a lot of the local government requirement. So just the high level monitor the entire sector's counterparty risk, or that's most of the time should be fine. But if you get like the big risk, ever grade something like that, you have to just keep monitor and doing research on that.
Yeah, and in this fund, I don't see any of those private developers. All of these companies that you see in this fund are large SOEs, and it's hard to imagine that a large SOE is going to fail without ensuring that employees and bondholders are safe. So
yeah, they also get some benefit of the China sovereign credit to support those kind of bond.
Exactly.
That's pretty good.
Yeah, exactly. So we're going to leave it there this week. There's a lot to cover on the policy side that's happening. Olympics are coming up. Chinese New Year is here. So we're going to get to those topics as they unfold. Hopefully you'll all tune in and hit the subscribe button. Thanks for staying with us this week.
Thank you.